Hey everybody, welcome back to the Economic Analyst. So the producer prices came out yesterday for the month of January 2021, and they were back on the uptick. So much to my expectations, I was thinking that this 1 month surprising drop that we saw in the producer price index of negative 0.8% from last year was just going to be a anomaly. And sure enough, that's pretty much what we got. Producer prices were back on the upswing, rising by 1.3%. Now that is substantially lower than what we have been seeing overall in the trending for the past 6 months or so, really going back all the way to May 2021. But we could be seeing more of a violent upswing onto this. I think the biggest cause of this has been the rebound in energy prices after they surprisingly, dipped a little bit in January. Also, with the Omicron variant fading, consumer spending is probably going to be driving up demand for goods, which is putting a strain on resources and supplies more than they did in January, as there's transportation that's going on. There will be upticks in demands for services as well as vacations and things like that. When we take a look at final demand upticked by 1% from last month. Again, that's up from the 0.4%. That's a huge upswing, and that's going to point to a higher price for the consumer price index. And I'll go into a little bit on that forecast in just a few minutes, right quick. One thing to take note, though, is that the consumer price index has been revised. They revise these numbers now every month. And so last month for December, they said that the CPI upticked by 5%. I want you to take note that it's actually now by 0.6%. Sorry, not 5%, but 0.5% last month. It's now been lifted upward to 0.6%. So revisions are going on in the CPI and adjustments are being made. And they're kind of lifting these numbers right now. We're seeing a similar trend develop in final demand. Final demand last month only showed a 0.2% increase. That has been revised now up to 0.4%. So that it's being revised, and it's being revised upward on that. So that's certainly not a good sign. Now, when we take a look at the consumer price index, the trend is clear here that month over month rates are showing that systemic ingrained increase, as we are seeing now that the CPI is becoming to reach this building level right quick, this huge building level of rising inflation that we have not seen since the 1980s. The last time that we could go back and see a lift of this building level really is in the 1970s, when we were starting to see that lift off to high month over month inflation that then peaked inflation at well over 10% year over year. So could we see that again develop? Well, there's definitely a possibility, unless if the Fed were to engage in substantially tighter monetary measures. But with the influx of high government spending, even though they're off the peaks from 2020 and 2021, high monetary printing and quantitative easing, even though that's being tapered back, I don't think it's going to be tapered back quick and soon enough to avoid some type of continuous rise in the CPI. So whereas last month I was hoping that we would start seeing maybe the beginnings of a peaking in the CPI in the next coming months, I no longer think that's the case. When we take a look at the producer prices month over month, the real changes right here was in food and energy. So as much as I expected on this, when energy prices dipped last month, that's what I was thinking was holding that PPI down. We had a surprise drop in food. We're seeing that bounce back now, so that's what's causing final demand to lift right quick. Other notes that have been provided by the BLS is showing that we're seeing final demand services ticking up in price as well as goods. There was the idea that was thinking that as services were to be lifted and started to rise because of COVID restrictions being lifted, that this would somehow put less of a strain on goods, but that's no longer the case, because services actually compete with goods for the same resources. So that's making goods resources less available, which is still pushing up its price. It's just now there's a demand for services as well, and it was not, the weighting was not adjusted to show that drop in demand as it really should have. Otherwise, we would have seen even higher prices on the final demand index and therefore the consumer price index right quick. So when you take out a look at, when you subtract out food and energy and then trade services, final demand is up by 7% year over year. That's the highest that we have seen on record since final demand has been keeping on an uptick. And again, as with the consumer price index, I don't think that's going to abate anytime soon. The Fed is just too far behind the curve on its monetary policies, and the government is way far behind the curve on its fiscal policies to try to really slow that down. We may see a relative drop in the month-over-month increases as government spending is on an annualized basis. Annualized is probably down about $800 billion from where it was a year ago. So 1 year ago, government spending was over $10 trillion. That's dropped to about 9.2 to 9.3 trillion. And that might have a slowing down on consumer prices eventually, but certainly not going to manifest anytime soon in the coming months. Whereas before I was thinking that we were going to see a peak in March and April of prices, I no longer think that's the case. Instead, I think we're going to remain permanently elevated as the last 3-month trend is showing a 0.75% increase in final demand month over month. The 3-month trend itself is showing the median at 0.9%. So we take that midterm and averaging out that number, looks like it's going to be 0.83%. And so until we start seeing that trend change, I really don't think I'm going to come off of this prediction that we're probably going to stay at about 10% year over year price inflation for final demand. Now, how does that translate into the CPI? Well, I'm going to go over February's prediction in just a second, but going and looking at the longer term, it looks like it's going to be building up the CPI. The CPI is going to build up to about 9% at the end of the year, which Professor Steve Hanke had predicted that inflation would stay between 6 and 9% this year. Looks like Hanke's going to be right on the dot, and it looks like it's going to be on the upper end unless if we start seeing these trend changes, and it's going to have to change quickly. But again, the adjustments in monetary policy and fiscal policy take time to resonate out in the aggregate economy, particularly on the monetary level. It would take at least a year or two before we're really going to see the effects of the relatively deflationary monetary policy versus the relatively more expansionary monetary policies going on now. When we take a look at the final demand model, I've tweaked this model a little bit to be a little bit more accurate. It's now nearly 90% accurate, whereas the last model was about 85 to 88% accurate. This one's close to 89. And this is, again, just using, really it's just going off the last month's percentage of CPI's percentage of final demand prices once you adjust for the previous month. Whereas before, I was assuming that the CPI would always hover around 100%. We are seeing a divergence develop between the producer price index and CPI inflation right quick. I think a big part of this has to do with the fact that the shelter component is lagging in the consumer price index. But shockingly, when you take out that shelter component, we see an even wider divergence between consumer prices and final demand because the weight is just not there to show that correlation. So I'm still going to keep that shelter component in. That was very shocking for me. I thought it would realign the two graphs together, but it doesn't. It actually separates it out. But certainly the lag that we're seeing in shelter prices is contributing to this divergence between final demand goods and the CPI. I think another aspect that might be contributing to this is the presence of Omicron shutting down consumer services. Now that we're seeing consumer services start to awaken, we might be seeing a return back to more normal levels of percentage of CPI and PPI. Looking at next month, it looks like that based off final demand and where it stands now, it's looking like we're going to get a 1% increase month over month in the CPI, and that's going to be a huge shocker. And that shocker is when it manifests right quick. Hang on one second. Let me adjust this number right quick. That shocker is going to manifest if this turns out to be true and it turns out to be right on the dot at 1%. Now, granted, remember my model is giving it a fairly wide spread. That means it's really be between 0.5 and 1.5. Means that the CPI is probably going to be about 8% year over year. And again, psychologically, I think that's going to ingrain inside investors' heads, and we're going to see more of the trends develop that what we have been seeing develop year to date so far. So the Dow Jones, the S&P 500, Wilshire, the NASDAQ are all dropping year to date. Bitcoin has dropped year to date. We're seeing a little bit of a rebound on it right now. Probably won't hold for a long while. I doubt that it will reach back up above this $48,000 coin level. It very well could, because the peak happened back in November. But again, we're seeing this downward trend in stocks and Bitcoin as I predicted, while interest rates have rising. But when we take a look at gold and we take a look at silver, we see that gold and silver have been on an uptick. They're on an increase. We can especially see this in gold since the beginning of January. Silver is starting to reemerge starting in late January and February, but it's definitely going to be more volatile right there. Now, the next video I'm going to produce is going to be talking and developing out what we're seeing in this gold uptrend that we're seeing, and how that's going to manifest throughout the year. So just to give you the insides looking into it, I'm predicting that gold will end up somewhere between $2,100 and $2,400 an ounce by the end of this year, depending just how strong we see in that upgrowth. I'm definitely getting more bullish on it now that we're seeing that the inflation numbers are going to stay high. Silver, I'll do a separate video on that, because silver is a completely different animal to gold in terms of its pricing mechanism. And again, I'll go into more details when we go over those videos. Now, back to the inflation numbers. When we take a look at the CPI analysis, year to date, if we get to this 8.8%, we're going to see this confidence in the US dollar year over year now, not for the last 3 years, but for year over year, plummet down to 40%. And it's going to bring the estimated confidence interval down to 62%. This is much lower than what we saw in the last 20 years, the last 2 decades, and it is much more reflective of the 1980s. So this was something I kind of touched on last video about the CPI, was that we may be seeing a bigger development of the 1980s, where we see that run-up of inflation followed by high interest rate policies by the Fed, or at least relatively higher than what we're seeing now, and then a calming down in the second half of the 2020s, hopefully speaking. But either way, this run-up of inflation is definitely going to be bullish for precious metals, bearish for stocks, and bearish for speculative assets like Bitcoin right quick. Again, it's hard to tell about, when we're measuring confidence in the US dollar, about where it's going to end up. So, expect these numbers month over month to change and adjust. But, right now, from what I can tell, it looks like we're ending up on a higher end than what I was originally thinking. And that's certainly not going to be for the good side of our economy. Guys, thank you for watching this video. If you like the content that I provide, make sure you just click that like button, show me some support. Subscribe to my channel if you haven't already. Click that notification bell. You'll be notified when I update and upload more videos. I'll try to upload my gold forecast video tomorrow, but if I don't get to it tomorrow, I definitely will get to it Friday. Until then, guys, I'll talk to you next time.